Every single time you take money out of a retirement account, your IRA, your 401k, any tax-advantaged account you spent years building, a document gets generated that you almost never see, and that document goes directly to the IRS whether you want it to or not. It's called a Form 1099-R, and buried inside it is a small 2-character code that tells the IRS's computer system exactly what kind of withdrawal you made. That tiny code is the difference between a completely uneventful tax season and months of unwanted correspondence with the IRS. My name is Finn, and this is Finn Retires, the channel that exists to make sure the money you worked your entire life to save comes out of your accounts exactly as cleanly as it went in. If this is your first time here, please hit that subscribe button right now. Today's topic sits at the intersection of two things we've discussed before: the IRS's automated matching systems and the rules governing retirement account withdrawals. Subscribe, stay with me, and let's walk through exactly what triggers IRS attention, one withdrawal type at a time. Every time a financial institution processes a distribution, they're legally required to report it using Form 1099-R, which includes a distribution code telling the IRS's system exactly what category of withdrawal occurred: normal, early, rollover, disability, and more. The IRS's automated underreporter system automatically compares that code and the income it represents against what you actually report on your tax return. When those two things don't match, a flag gets generated, a notice, a penalty, or a request for documentation. The first trigger is an early withdrawal, taken before age 59 and a half, without a properly documented exception. Under IRC Section 72T, this generally triggers an automatic 10% penalty on top of ordinary income tax. There are legitimate exceptions: disability, certain medical expenses, a first-time home purchase up to a specific limit, and others. Here's where the trigger happens. If your custodian codes the withdrawal as standard with no exception, but you claim one on Form 5329, that mismatch generates an immediate flag. The second trigger involves substantially equal periodic payments, a 72T SEPP arrangement. This allows penalty-free early access to retirement funds, but only if the retiree commits to identical payments for at least 5 years, or until age 59 and a half, whichever is longer. If a retiree modifies, pauses, or alters those payments before that window closes, the IRS doesn't just apply the penalty going forward, it applies retroactively to every payment already taken, plus underpayment interest calculated back to each original distribution date. The third trigger is an indirect or 60-day rollover from an employer plan. A retiree requests funds be paid directly to them, intending to deposit the full amount into a new account within 60 days. What most retirees don't realize is that employer plans must withhold 20% automatically. If you had $100,000 and requested a full distribution, you receive $80,000, with $20,000 already withheld and sent to the IRS. If the retiree deposits only that $80,000 check without making up the missing $20,000 out of pocket, the IRS treats that missing amount as a taxable distribution. And if under 59 and a half, it can also trigger the early withdrawal penalty. The fourth trigger is a withdrawal coded incorrectly by the custodian on Form 1099-R, using a generic code when a specific exception actually applied, or the reverse. This creates a direct conflict between what the IRS's system expects to see based on the custodian's code and what you actually report. It generates the same type of CP 2000 notice discussed in a previous video, but originating from a withdrawal coding discrepancy, not an income reporting gap. The resolution is similar. Contact your custodian to confirm the code used, gather documentation, and if they made an error, you may need a corrected 1099-R before the IRS notice can be fully resolved. The fifth trigger involves Roth accounts. Many retirees assume that once they're over 59 and a half, any Roth withdrawal is automatically tax-free simply because of their age. The actual rule is more specific than that. For a Roth withdrawal to be fully tax-free, the account must satisfy its own 5-year holding period, measured from the first contribution or conversion to that specific account, separate from the retiree's age. If a retiree is 62 but opened their first Roth account or completed a major conversion only 3 years ago, withdrawing earnings before that 5-year period is met can trigger both income tax and the 10% penalty, despite being well past 59 and a half. Let me bring this together with a real example. Consider a retiree named Arthur, 61, living in Georgia, who left his corporate job at 58 and needed to access funds before 59 and a half to bridge his income for about 18 months. Arthur set up a 72T SEPP arrangement on his IRA, taking carefully calculated identical payments each year, doing everything correctly by the book for the first 2 years. In year 3, Arthur's situation changed. He picked up part-time consulting work and decided to reduce his CPP payment, believing that since he was now past the standard early withdrawal age, the rigid rules no longer applied to him. What Arthur didn't realize is that his arrangements required duration extended to a full 5 years from its start date, not simply until 59 and a half, because it began before that age The 5-year minimum was the longer controlling condition. By modifying his payment before that window closed, Arthur triggered the 10% penalty retroactively on every payment since the arrangement began, plus underpayment interest calculated back to each original distribution date, several $1,000s that could have been avoided with one conversation with a tax professional. Here is what I want you to do. First, if considering any withdrawal before 59.5, confirm in advance exactly which distribution code your custodian intends to report, and make sure it matches the exception you plan to claim. Second, if you have a SEPP arrangement, do not modify or adjust the payment amount for any reason until you've confirmed with a tax professional that your 5-year window has genuinely closed. Third, if doing an indirect rollover from an employer plan, remember 20% will be automatically withheld, and you must make up that difference from other funds within 60 days if you want the entire balance to roll over without tax or penalty. Fourth, when you receive your 1099-R each year, review the distribution code carefully. If something looks incorrect, contact your custodian immediately rather than waiting until tax season. And fifth, before withdrawing earnings from any Roth account, confirm the specific 5-year holding period for that particular account, separate from your age, especially if it's relatively new or resulted from a conversion. None of these 5 triggers exist because the IRS is trying to catch honest retirees making innocent mistakes. They exist because the tax code allows genuinely useful flexibility, and every piece of that flexibility comes with technical requirements. A computer checks automatically, with no room for good intentions to smooth over a mismatch. If this video changes how you'll approach your next withdrawal, share it with someone who has a 401k, an IRA, or a Roth account, and might be considering an early withdrawal or a SEPP arrangement soon, and drop a comment below. Which of these 5 triggers surprised you the most? I read every single comment personally.